Hi, it's Dave. Today I'm joined by James Douma. He's a frequent guest on my channel, a machine learning expert, and we've been doing a deep dive into Tesla's full self-driving feature, but also how to approach not just the technical software side and the hardware side, but we're also going into modeling. How do we model full self-driving? In the first part of our conversation, we talked about ARK Invest's model. I'll link that in the video description. And in part two, we talked about creating a model of how Tesla full self-driving could be validated by regulators, depending on what miles and what time period. And so in this episode, part three, we're going to dive into a long-awaited modeling session where James is going to kind of walk us through a way to model how much Tesla full self-driving could be worth to Tesla's valuation. And so, I want to welcome you, James, to the show again.
Great to see you again, Dave. As if we haven't been talking now for a couple of hours.
Exactly.
Okay, so we're going to. This is a continuation of like how to build a model, sort of stuff. And the idea here is to encourage people to don't get a model and just accept the numbers out of it. Take the model apart and try to understand what's really going on. So with the ARK model, we took it apart to try to understand what was going on. And hopefully people got a couple of things out of that. I mean, ideally, you one of the things you get out of it is a healthy skepticism about the numbers. Another thing you can get out of it is like, oh, I can go in and play with this model and change it. I mean, ARK gives us the models, and so which is great. It's really great that they do that. So you can understand what their assumptions are. You can change the assumptions, and you can explore the space of possibilities and get a feel for the spectrum of future outcomes that the model is talking about. So it's not just a point. You're like, here are the risks, here are the upsides. I understand what's going on. So, of course, one of the best ways to understand a model is actually build the model yourself. And I'm a fan of simple models, and so we can do a simple model demonstration. And one way of thinking about the valuation that FSD Robotaxis bring to Tesla, you can do complicated models, but I like really simple models. And one really simple model is to think of the value of the taxi not in terms of, like what would somebody pay for this, but rather what will people pay for a mile? And the nice thing about that is that we already know what people will pay for a mile on a taxi. We have a pretty good idea because there are taxis and we know about how many miles they can drive, and we know about what people pay. So if we just applied that, if we started from that perspective, like what would it say about what FSD would be worth to Tesla in terms of their enterprise value? So if we want to know, obviously we need to figure out like how many taxis they're going to have, how many miles they drive, how much they can charge per mile, and then like how much of that value can Tesla capture, and then we can drop that down to the bottom line and make some guesses. So I'm going to build a quick little sequence here that walks through that stuff. So of course we have to start with how many taxis there are, and that means we have to predict, because we want to look out, we're going to look out, say 5 years. We could look out 10 years or something like that, but let's say we're going to look out 5 years. So we know what they built this year, right? We know that let's do this, year 2000 and vehicle production. So we know they made 500K cars, and that there were about 500K cars prior to this year. And then each subsequent year, this will grow by some amount. We have to figure out what the subsequent ones are. And just to keep things simple, we'll pick a growth rate. So we'll say, it'll increase with so many percent every
I think it's the 2020 year.
Oh yeah, 2020. Okay. So another thing that we care about, let's see. Another thing we care about is what are the vehicle ASPs? So we want to understand how this is going to affect Tesla's bottom line. John. And so a big part of the bottom line is what they make now, vehicle ASP. So let's say we're going to do this in kilo dollars, and we will do vehicle production in K vehicles. So we'll just start with like a nice round 50K for what the vehicles are worth. Okay, and then what does Tesla get to keep out of this? So the vehicle gross margin is the selling price minus cost of goods sold. And we know that Tesla runs around 20% on this, so we'll just start with that number, 20%. Okay. Okay, then of course there's some overhead for the business, SG&A plus R&D. We can pick some number. There's also, I guess, capital that they put back into the business for building factories and stuff like that. I'm going to leave that out for now. We could add it back in later. So let's say, I think SG&A and R&D, we'll start with 10%. Okay, so from these things, we can figure out an approximate gross profit that the company is making after taking out overhead. Right, so we'll put gross profit here. And that's going to be cars times ASP times the gross margin minus overhead. So here we're expressing overhead as a fraction of sales, which we could change, but we'll stick with this. And let's see, that's thousands times thousands. So this is a gross profit. Well, let's divide this. Let's make it billions because that's an easier number to look at. So we'll divide by 1,000 because we were in millions before because we're multiplying thousands by thousands. So now we have gross profit in billions of dollars. Okay, so we have a starting point now. So let's go ahead and just work our way down the rest of this thing. So what does FSD bring? So we want to make some assumptions about how many vehicles there are in the fleet. So let's do that first. Fleet vehicles. So because of the way Tesla is doing FSD, when they roll it out, it'll be available not just for new cars that they manufacture, but for previous cars. So the total taxi fleet is not how many cars they built this year, but how many cars they've built up to now. And at this point, okay, we're going to do this as a continuing sum. So B6 to B6, and we know that they already have about 500K before 2020 that were out there. So that's 1,000. That's 1 million vehicles we get. Let's sum B6. Okay, we'll extend this later. So fleet vehicles. So let's we'll put in a number here that we can play with for the fraction of fleet used as taxis, and we'll just pick a number and we can play with this later. So here's a random number. Okay, we want to make an assumption about how many miles a year does the average taxi drive? Taxi annual miles. We'll do that in thousands of miles. So ARC has done some research. They have a range of numbers. They feel like 110 is the middle of the range of reasonable numbers. I guess it seems like they got this number by looking at taxi fleets and then kind of extrapolating that to what a Robotaxi could do in a 16-hour day. Anyway, we'll start with 110K just with ARC's number. We can also play with that later. Okay, so what else? So what do we get? So fleet vehicles. Okay, so total taxi miles. We want to end up with a number that basically tells us how much money Tesla can make off of their fleet. So we're going to figure out how many miles the taxi fleet drives. We're going to stick in a number for how many dollars per mile they charge, and then a percentage that Tesla takes off of that. So we'll do that. So total taxi fleet miles. And so that is going to be this number times this number. So, and that's thousands of vehicles and thousands. So times 1 million. Divide by 1,000, that should give us billions of miles, right? Get this right? So this is fleet vehicles in thousands. Let's actually do a thing where let's switch that to millions, because I think that's going to be easier to look at going forward. So we'll divide this to just make the range a little bit cleaner. Okay. So, oh wait, no, we have to multiply by the 50% also. So let's get that in there. Equal. Okay. And I guess billion miles is not actually easier. So we'll do taxi fleet miles in millions. We'll get rid of our divide by 1,000. Okay.
Wait, on
55 million miles.
on line 12 fleet vehicles, you did before the total number of vehicles in the Tesla fleet.
So then I multiplied to figure out what to get the total taxi fleet miles. I'm multiplying this and this and this together. Because unfortunately the font here is a little small, but I am multiplying the 50% in there now. It wasn't before.
To the fleet vehicles?
Yeah. So there's I
think you had it right before.
So I didn't. Yeah, you're right. Yeah. I shouldn't have put it in this line. I put it in the little. This is what building models is like. You think through this stuff while you build it. Okay, what I really wanted to do was put the 50% down, included in this line, right? Okay, so we get 50 million miles, and we got 1 million vehicles, 55 million miles. Okay, let's see, taxi rate per mile, and we'll just start with $1.
I think.
Let's see. Yeah.
I think it's not mile. Is it? I think it's billion. Line 15 would be billion miles.
Well, it's a million. Oh yeah, because it's 110K. Yeah. You're right. Thanks. You're debugging while I'm working my way through this. Okay. Let's say Tesla takes 30%. So Tesla, let's see, Robotaxi revenue. So this is their revenue. So we're going to multiply this times this times this, and that's in millions. No, it's in billions. All right, B17, 17, 16, 15. Oh yeah, so that's Robotaxi revenue in billions of dollars. Okay. Now, of course, there aren't any robotaxis in 2020, but what we're going to do is replicate this out. So this is Tesla's gross profit from the sale of vehicles, and this is the gross profit from the robotaxi revenue. Wow, that's a really large number. So, well, they're not running robotaxis yet, and we have 50. We have some assumptions in here. So we want our production growth rate. We want this to be a variable we can play with. So I'm going to put it up here, and let's say they grow the fleet 50% a year. 50. Come on, give me percent. Okay. So the next year we make this times 1 plus this. Okay, so 750. Okay, let's see. We'll leave the vehicle ASP the same for now. Actually, no, we assumed that the ASP was going to go down like 5% a year or something. Is that right?
Yeah.
Okay, so we'll do 0.95. So we'll let the ASP go down by 5% a year here. We'll let's say that stays the same. We'll say, so overhead, if production, now this is expressed as a fraction of vehicle revenue. So if we just keep this the same, then we'll be assuming that the SG&A and R&D increased by 50% a year. And Tesla clearly has not increased them at that rate, but we want to have some kind of increase in here. So let's assume that they increase at maybe half of this rate. So that's basically, if we reduce it by 20% a year on 50% growth, well, okay, we'll just do that. So we're going to take 0.8 times 10%. Oops. Wait, how does that work? Times this number. Okay. So now that'll decrease. This just gets calculated up from there, and then all these get calculated also. Okay. So were the fleet operating in 2021, and were we getting all these numbers, it would look like this. Okay, so now we can just replicate this column across because we made it so it chains off of the earlier one. So here we see the production numbers gradually crank up according to this growth rate that we have up here. We see the vehicle ASPs gradually creep down at 5% a year because that was what we set in. We're leaving the gross margin the same. We're letting the overhead as a fraction of vehicle production revenue gradually decline, so that it's actually growing in absolute terms. It's just decreasing as it's not growing as fast as the production rate is, and so the fraction of revenue comes down. Okay, gross profit. So gross profit, it goes from $2.5 billion for vehicles to $24.6 billion in 2025. Okay, let's make these numbers a little more readable. Do this. And we want to do that with this column. I want to do it with like this column also, this row. Okay. So now we know Tesla didn't operate robotaxis in 2020, and they're probably not going to do it in 2021. It's debatable whether it would happen in 2022. And you could debate it in other years too. The point of this exercise up to what we've done right now is basically to get this chain going so that we can have these later years where we can look at what robotaxi revenue means given these assumptions and compare it to like what they're making off of vehicles. So we've got some expectations about their future vehicle performance. And obviously this model is showing a pretty rapid rate of growth in these in vehicle gross profit. We're going from, it's basically increasing 10x between 2020 and 2025, given this 50% growth rate, and assuming that, these other characteristics also hold true. This is even with the ASPs declining. Notice the ASP is down 20% over this period of time, and yet the revenue still grows pretty rapidly. But the flip side is that the potential robotaxi revenue that you could get, given the assumptions that we have in here, is actually dwarfing what they make off of vehicles. Now, this isn't the sale price of vehicles. This is what Tesla gets to keep after the cost of goods sold and the cost of operations for selling goods. And it's a very crude model, obviously. These are, pretty simple set of assumptions. So in this model, it looks like robotaxi revenue actually makes a really big difference. If we obviously we're getting several times more out of robotaxi revenue. So what would be wrong in this scenario? Because this definitely has that too good to be true kind of number. So let's be critical about this. So one thing we could say is, well, how many taxis? So there's 600 billion miles getting driven here in 2025. And how many taxis are there? So this is 10 million taxis. So the United States has a few 100,000 taxis in it right now. So this would basically represent a pretty dramatic increase in the number of taxis on the road. So one thing that we could imagine is that the price you could get per mile would go down, and we would want to play with that, or maybe change this number around. Let's see, is this copied? So we would expect the price per mile to be comparable to the human-driven fleet at the point where we're matching that. So the human-driven fleet is a few 100,000 vehicles. So, I mean, it seems like if Tesla were to start Robotaxi in 2022 or 2023, they start with more vehicles. Of course, we're assuming that 50%, is that what we have here? We're assuming that 50% of the fleet gets used as taxis, say in this first year. So, is this copied? Okay, so no cars got used as taxis in 2020, and probably none will get used in 2021. In 2022, maybe in 2022, it's also zero. Because in 2022, let's say they don't get regulatory approval until the end of the year. So then let's say, well, so how many vehicles would be a reasonable number for 2023? So how many people who owned Teslas at this point might reasonably want to put their vehicle in the fleet? So I guess what we can ask is, like, how good a deal is this for vehicle owners? And so what's the vehicle owner gross receipts? So the vehicle owner would be getting the 70%, 1 minus the platform fee times the miles. Oh, and this is for a single vehicle. So if we want to look at a single vehicle, this is going to be like the vehicle miles driven times the rate that we assume times 1 minus what Tesla takes. Okay, and what is the units for this? This is thousands of dollars. Is that right? Yeah, this is thousands. Yeah, okay, so the vehicle owner gross receipts in K dollars. Okay, so if you were to put your vehicle on the fleet under these assumptions, so there's 4.6 million people who could take this deal. That's the size of the fleet. Let's say 10% of them take the deal. What does that end up looking like? So if 10% of them take the deal, then that means the total taxi fleet miles is 50 billion miles. Okay, so Americans drive 3 trillion miles a year. So this would be a small number it's a small number compared to the total miles driven. And it would be 10% of 4.6 million vehicles is 460,000 taxis that might enter the fleet this year. And so that's kind of on the scale of what the number of taxis that are out there that are being driven by humans right now. So would $1 be a reasonable rate? Taxis are 2 or 3 times that. So yeah, you could get $1. I mean, it's not beyond reason that you could get $1. So, if your Robotaxi drives 110,000 miles a year and you get to keep 70% of the $1 a mile, then that's $77,000 of gross receipts that a vehicle owner could accrue under this scenario. And maybe it's not hard to believe that 10% of people would take that deal. So this is a process that I just went through. So let's see, does this change? So this number is going to stay the same because we haven't changed any assumptions that are going in this. So we just built a basic model and we built a narrative up to 2023. And so the process I went through is I stuck in some basic numbers. I looked for places that they could be grossly wrong or where they don't make sense. And I tried to check them against one another. For instance, I sort of sanity checked myself on whether or not they could do this. I mean, we know they didn't do it in 2020. So this 0% number as a given. In 2021, it seems super unlikely that there will be taxis. You could argue about it in 2022 or 2023, and some people might argue even later than that. But I've got this narrative where I've picked a certain number of cars. I put some number in for the number of cars that are driving, and then I asked myself, does the rate for the taxi end up making sense given this many taxis on the road and what we know about what people are willing to pay for taxis today? And at the 10,000 foot level, it looks fine. Now things get a lot more complicated when we move beyond this. Of course, one of the things that happens in this year, right? So if it's 10% again in 2024, you've now gone from 400,000 taxis driving to 700,000 taxis driving, and the fleet miles has gone from like 50 billion miles to 78 billion miles. So one of the things that you have to wonder is like what the price elasticity is. Like there's going to be only so many taxi miles you can sell at $1, and $1 might not be the right number here. I mean, $2 could be the right number here, which has a pretty dramatic impact on what the vehicle owner makes. I mean, this is a great deal, making $150,000 on your car in 1 year, which might be an argument for why it will be cheaper, because if the better a deal this is, the more people that take it, the more competition will drive the price down. And so you can play around with these numbers to come up with a scenario that you like in terms of like, how many people do I think would take that deal? How many people do I think would ride in a taxi at this rate, given what I know about taxis or what I think about price elasticity? So here's a basic model, right? We just went through the process of doing a really crude model of what Tesla makes on cars, or what they could make on cars. I mean, they're building a lot of factories right now, which is something that we don't have here. I mean, Tesla didn't make $2.5 billion in profit on 2020. Actually, I don't know exactly. They made a profit, but it wasn't that large. But the money that they did make on their car business, probably their overhead was higher. It might have been a bigger number than this. And then they also spent a lot of money on factories that year. So that basically wiped out this number. And you can play around with these numbers to zero that out. And maybe you want to make different assumptions about how overhead scales over time. It could be done more clearly than I've done it here. I'm basically deducting the overhead from the production growth rate and the way that I'm doing it right here.
Yeah. I think the overhead was probably a little higher, and the factory expenses actually go into Capex, so they wouldn't really go into the overhead, I think.
Yeah, so we'll insert a line here for Capex. And Capex is probably, so now what we want to do is we want to calculate this by subtracting Capex additionally, right? Minus B10. So Capex is 10%. Now your profit is 0. So we have 20% gross margin, 10% to overhead, 10% to Capex, and that basically zeroes out our profit in this year. So maybe you said you thought overhead was larger?
Yeah.
15?
Well, I think, I mean, that's fine. It's going to be, I think actually Capex is not part of actually the profit loss. It's amortized, depreciated,
right,
into the cost of goods. So you can actually erase that Capex expenditure completely. It goes into more of the cash flow, but not into their profit loss for that year. Yeah.
So because this is our model, we can define anything any way that we want to, and because we can decide what all of the numbers. What I'm trying to get to, what this model is trying to get to in this point is if Tesla after 2020 was a static business, if they stopped investing, like what? So one of the things that you do at the end of this is you say, well, Tesla has 1 billion shares outstanding. What's a reasonable stock price for this? And that requires you to make an assumption about the price earnings ratio, or the price to the enterprise value, given that the enterprise value that investors would assign to it given certain cash flow characteristics. Now, we understand the price earnings multiples for stable businesses a lot better than we understand them for growing businesses. So one way to think about, to translate that, like if the market conditions will give me a 20 PE on a stable cash flow, one of the things I can say is, well, how do I turn a thing I could do is try to assume that I'm not spending on the future and it's a stable business at a particular point and that it's not growing. Another thing you can do is you can use a price earnings growth multiple, where essentially you can ask, well, what PE ratio do other companies growing at a certain rate get? And of course, Tesla kind of breaks that because nobody grows as fast as they do, right? So anyway, this is, if we get rid of Capex, this number is cash that is in some sense profit from the operations of the business. And the point of this exercise on this model was to basically try to understand how robotaxis compare to the car business, to give us an idea of what the multiple, for instance, if you had a successful FSD business, like what does that mean to the enterprise value that you would otherwise have? And at least using these assumptions I have right here, and of course, one of my investing thesis in Tesla is that it makes a really big difference. And so in this scenario, I haven't tried to come up with reasonable assumptions for these other numbers beyond 2023. I'm just stopping at 2023 and looking at 2023. We're already at a point where Tesla's got a big enough fleet on the road that even if you take a small chunk of that fleet, in this case it was 10%, and you might argue that it would be less than that depending on the conditions. But it seems like there's plenty of incentive for some number of Tesla owners to put their vehicles in the fleet. And once again, one of the parts of the narrative going into this model is that Tesla is doing what Elon talked about in the past, like they have the Tesla network, and that owners are invited to put their car on this network, and that's where some pool of the vehicles or some significant chunk of the vehicles comes. Tesla also said that they might put their own vehicles directly into the fleet in order to supply vehicles in places that were undersupplied. And I haven't modeled that right here, but that would be another interesting spreadsheet to do. Like, what business, you figure out what you think like Tesla themselves could make off of a vehicle that they put in a fleet as opposed to a vehicle that they sell to somebody, and ask yourself the question, well, let's assume Tesla puts a certain number of vehicles in there. So what does that do to profitability? Obviously the structure of that is a little bit different, but it's an interesting spreadsheet to do, to explore the business case, to sort of understand, to use some numbers to get a sense of what makes sense just with simple math. But here, just looking at 2023, like none of these numbers is going to be right. But you can ask if they're reasonable. And when I look at the numbers, they look not unreasonable. Reasonable being, am I unrealistically overestimating the potential for FSD profit to Tesla? I've got a platform fee in here. I don't have any operating expenses for them. So one of the things in here is that you have to ask the question about, look, how much money are they spending operating this service? And of course, one of the things about the business, how you might expect it to go together, is that Tesla they take a platform fee, and for the platform fee, they maintain an app that people that ride-hail customers use, and that vehicle owners would use to like put their vehicle in the fleet. They probably have insurance costs because they would be covering the cost of insurance while it's doing this. They might cover the cost of electricity. That's actually really small. I think electricity cost is like 4 cents a mile or something like that. So it doesn't really affect, it's a pretty small number on this scale. So you might be able to ignore that. But then they have data centers. And then there's the question of like, will they be washing the cars for you? There are ways that they could spend money making the service more attractive to vehicle owners if what they decided was that that they want vehicle owners, people who already bought their Teslas, to be enthusiastic about trying to earn an income, either because that's your full-time gig, like running a fleet of cars, or basically just because you have a vehicle that you're not using all the time, and maybe you can put it in the fleet so that it pays its own car payment and whatnot. And it seems like there's potential for that here. Okay, so we built a simple model.
Yeah. I think, I mean, that's a fantastic, I think it's a great thing for people to know how to do it, but also put in their own assumptions into, the whole point of this exercise wasn't to get the right assumptions, that's up to each person, because that's the whole point of investing, is you're creating your own assumptions, and you're putting at stake what you believe. It could be very different than what James believes or what I believe or someone else, right? And that's the whole investment story. So, but I think just having the model, understanding how to, I think what's typical is that whole first section of kind of the revenue and gross profit and overhead, et cetera. The bottom part of kind of just taking simple stuff like, cost per mile, and what the percent of fleet that will be enrolled in Robotaxi, and how many miles, and and the platform cut, and to get some type of gross profit from Robotaxi. I mean, what's interesting is that's the new business for Tesla. Like, this is not an existing business. Like, the car business is existing. This is what every single model from every analyst is banking on and is putting Tesla's valuation on, right? This new model of this entire new market of autonomous ride, transportation as a service, in a sense, like, this is the new way where Tesla is going to be valued if they're able to pull this off. If they're able to pull off autonomy, there's going to be a new way to value Tesla. And I think what you're, getting at is that, this is a simple way. Our invest model was a little bit more complex way of doing something, similar in terms of valuing autonomous driving, but with much more variables and using, which for most investors, they don't really need to go through that type of maybe extensive, modeling, with a Monte Carlo model, et cetera. It's probably easier just to do a simple spreadsheet, put down the assumptions that you think are most reasonable, right, per year, calculate the profit. And I think one of the interesting things also is you're going to have to come up with some type of multiple that you think that investors might give off of those profits, at that, time, and depending how fast they're growing, et cetera. And so what are your thoughts on that? Let's say hypothetically, Tesla is able to pull off, I don't know, Robotaxi, and there's a good amount of, let's say, an optimistic scenario. Do you yourself calculate a type of multiple off of the gross profits that you're calculating that you think investors might value the company at?
You have to, PEs are hard because they depend on investor sentiment, and a lot of things affect investor sentiment. It's a PE is basically, how much do I think investors will pay for a business that has these characteristics and this profitability? And sometimes investors pay a lot more than the rule of thumb would be. I mean, Amazon famously has a super, super high PE and had a super high PE for a really long time. And a big part of that was because investors understood that their earnings on paper were really low because they were investing all that back into the business. So, investors to some extent were looking at that saying, well, if they stopped growing, they would be crazy profitable. So if we compare them to, if I compare them to Walmart, which is not growing very fast, or I compare them to some other internet company that isn't growing very fast, you can get a sense of how much higher the multiple ought to be, or what it would be if they stopped trying to grow. Tesla's growing crazy fast, and so typically you get a significantly higher multiple for companies that are growing crazy fast. But the super conservative thing to do is to say, well, what's an S&P 500 multiple? And it's like 20 now, and they peak at like 25 or something like it. So S&P multiples rarely get any higher than that. But then S&P companies they're never growing 20% a year either. By the time you get into that, it's super rare for an S&P 500 company to be growing 50% a year. That's just I don't think that's ever Has anybody ever done that?
Yeah.
I don't think so.
It's the growth rate plus it's also the gross margin or the gross profit. For example,
Yeah.
this is a
The
software
margins are
this is
good.
a software business. You can get 80,
Yeah.
90%, right? So you're
Could be.
the growth rate
Yeah.
you're capturing, almost all of that additional revenue and profit. And then you have to also probably consider the total addressable market, which is with transportation as a service, autonomous driving is humongous.
So 10 trillion miles a year globally, potentially, that
Yeah.
you could displace. And if you can outcompete people driving their own cars, then it could be even bigger than
Yeah,
that.
exactly.
Right?
Yeah.
Like if it's I mean, for some people, it's a win on day one because they don't want to drive. Or for some people, it's a win on day one because they don't want to have a car. They live someplace like San Francisco is a place where owning a car is not fun and it's not cheap. So taxis they have a great head start in those kinds of locations.
Yeah. 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 Awesome stuff. Yeah.
Do we want to do anything else with this? Oh, so here was the thing that I did. So I started this whole model with with kind of this perspective, like, if you think Tesla's worth, X dollars, like whatever some analyst says, they think that Tesla would be worth under this scenario, and they're not modeling FSD. But FSD basically increases the profitability of the business. The way we're talking about profit here, where we're excluding Capex and those kinds of things, by 2.5x, and that's under this assumption where 10% of the vehicles are in the fleet, and they're getting $1 a mile for the taxis, and the taxis can go, like, most of these numbers are pretty solid. Like this number, 110K, it's not gonna. I mean, it could be lower. It's not going to be dramatically lower. It's not going to be dramatically higher. There's just so many hours in the day, and we know about how fast cars move, so that it doesn't vary a huge amount, maybe 2x. Or could any of these numbers be off by a lot more than 2x? And yeah, this percent of we really don't know how many people would put their cars in the fleet, right? And so obviously, like if this number is 1%, it reduces the profitability of this business. On the other hand, if it's 50%, the profitability is kind of ridiculous. It's now 8 times bigger than Tesla's car business if it gets 50%. So we don't understand this number. This is one that you probably want to really think about if you're going to use this model to inspire. What other things? Then you could debate the platform fee. 30% is a number that Elon floated at Autonomy Day, and so that's why I've got this number in here. But you could imagine it being higher, or you could imagine it being lower, depending on whether you feel like Tesla is really incentivized to maximize the number of taxis out there and share the revenue, or if you feel like they're really incentivized to, I'm building this taxi and it's worth $250,000, and Tesla deserves a cut of that, and we're going to use it to build more factories, or we're going to use it to accelerate the rollout of other services that we have, accelerate energy, accelerate solar roofs, that kind of stuff. But now we got a formula. We have a framework for thinking about this stuff, and we can add things to it. We can play around with the numbers, and we can see what playing around with those numbers does to the bottom line that we will be using to inform our investing decisions.
Awesome. Fantastic. Sounds good. Would you be willing to put this is, you have it on a Google spreadsheet. Would you be willing to share the link with folks, or are you
am I really going to save anybody? Yeah, of course. Like I'll mail you the sheet. We can mail it out.
Yeah. I think we'll put something disclaimer. We'll just say, hey, use your own. These numbers.
This is not investing.
These numbers aren't projections. This is just.
If the people watching us don't at this point understand that we're a couple of clowns, they really should take everything we say with a giant grain of salt. Not investing advice.
Yeah, exactly. Awesome. Yeah, sounds great. I know you're going to be on a road trip for a few weeks, so we're going to be missing conversations with you. And I don't know what some people are going to do without their, a regular dose of James Douma and AI and full self-driving.
There's so many hours in the can for this last couple of weeks. I think they'll be saturated.
True. Yeah.
I'm surprised anybody can continue watching these things after. We must have like 15 hours or something now. It seems like.
Yeah. It's actually it's like a course. It's like a course on Tesla Full Self-Driving and covering different, like it's a lecture. So you have one on like neural nets, one on the software, the architecture, another on the chip, the hardware, and competition on the.
This sounds like a rationalization.
But on like, you know, modeling and valuation. So yeah, it's definitely valuable, I think, to myself to go through it, and I think for lots of people. So definitely appreciate it.
Great.
Cool. Awesome. Okay, we'll talk to you later.